Hello, hello. Good morning. Happy Wednesday, everyone. I hope you are enjoying today because it is beautiful, it is gorgeous, and I love me some summer weather. I am not going to kid you. I am a Southern California girl through and through. If this is your first time joining us, well, hello. My name is Sadie Uribe, and I'm the media producer for the Los Angeles Regional SBDC. The SBDC is a national program with over 1,000 locations across the country, helping to stimulate economic growth through business advising and development. The LASBDC offers no-cost services through funding provided by the U.S. Small Business Administration, SBA, and from the California Office of the Small Business Advocate. It's your tax dollars at work. The Los Angeles Regional SBDC network operates 7 service locations throughout Los Angeles, Santa Barbara, and Ventura counties. Our services are also offered virtually. We are here to help. We empower small business owners by offering tailored solutions through personalized one-on-one business advising, cutting-edge workshops, and comprehensive programs, all provided at no cost. We are dedicating to supporting your entrepreneurial journey every step of the way. Lori, I felt that today. I mean, and you know what? I do believe today is actually SBDC Day. Like now that I put my mind on there, I'm like, it's SBDC Day. We're celebrating 10-year anniversary of it.
Well, you know what? And we're supposed to be on top of this. Hey, I knew it's SBDC Day, right?
Yay!
Hey, see the balloons in the background, everybody. Hello. Okay. I don't know if anybody else noticed that Zoom updated yesterday. So I was just sitting here pushing buttons and everything. And so, Sadie, if a question comes into the question box, unless you can, quick ping me on where is the question box now, let me know. You may have to monitor that for me. So, with no further ado, guys, this is so fun. We're going to have a great day. Let's get started here. So, let's see if everything else is correct on Zoom today. Okay, so I have my CFO series coming up, and Sadie will put the links in there for April already. I can't believe that. So please do consider joining. Like, I can't tell you enough. You need to know the numbers. I'm tired of people calling me and crying because they're in bankruptcy or broke. If I could have just, I can't tell you how many times people say to me within 1 week, if I only had talked to you before. So I'm saying to you guys, you can talk to me before. Check out my CFO series. Okay, end of the month. I didn't list my April yet, but for end of the month, I know. Matthew Schudorf is coming on to talk about Roaster Cafe de Leche that him and his wife launched. They've got 2 locations. New story for me as well. So we're all going to learn together. Pretty excited to have them on the show. Now, today I'm going to talk about something that I had like one thing planned, but I've had so many people already in a situation. You know, I always come to you live with what I'm experiencing. So here's Lori's Corner. I'm going to go through a lot. Sadie is going to put some links into the chat. If anything I say resonates, you're like, oh my God, that's me. Sadie will also put my contact information in. You know how to get in touch with me through her, etc., that you can get more information on this. So here we go, because I just want to go through quite a lot. And here I go. Okay. So I hear a lot of people say, I opened my LLC last year, but I had no sales, no money, nothing. So I didn't file a tax return. So please listen up in these situations. That mistake can quietly cost you big time in California, even if everything's quiet right now. Because here's the simple breakdown that every small business owner in California needs to know. So let's first talk about on the federal level. Because as I talk to you a lot about this, you've got to look at taxes and then legal structures from where it is required for taxation on the federal side, what is required for California on the legal side, what is required for California on the tax side. These things don't always play together like you think. So on the federal side, I'm speaking IRS, okay? A single member LLC is a disregarded entity. You guys might have heard that word. Well, this is what this means. You do not have to file a separate federal tax return for the LLC if you didn't do anything, if you had no transactions. Everything just flows through to your personal form 1040 if you had transactions on a Schedule C, usually for a single member. No extra paperwork federally if you're the solo owner, okay? But in California, franchise tax board, think franchise tax board, every LLC, single member, multi-member, does not matter. They must file Form 568 every single year if it's registered with the Secretary of State. So if you're registered with the Secretary of State, not dissolved, you've got to file this form. Zero transactions, zero income, zero activity, doesn't matter. You still owe the 800 annual tax and you have to file this form because California treats your LLC as a separate entity for state purposes. So skipping it can lead to your business being suspended, forfeited. I'm seeing letters come out from California where people are finding they didn't file this form. They can get failure to file. It can really, really stack up. Now, I want to talk just for a second on deadlines. You know, deadlines matter, especially in tax season. So, sole proprietors and single member LLCs, the deadline for filing is April 15th. Now, what a lot of people don't understand is multi-member LLCs, that's more than one member, okay? They're treated as a partnership and they have a deadline of March 15th, which is the same as corporations. So yesterday I just talked to a multi-member LLC that was said, well, we're getting our tax prepared ready for April. I'm like, oh no, you're already late, okay? So miss these and the penalties start stacking up. There is a higher penalty for failure to file than failure to pay, guys. So you want to get an extension, especially if you were needing to file on March 15th, get that extension filed now. So if you open that LLC, you went quiet, don't ignore the mail from Franchise Tax Board, file the Form 568, pay the 800, keep your business in good standing. It's one of those hidden California rules that catches a lot of owners off guard. And Sadie is putting a whole bunch of links into the chat for you to research on your own. And as always, you can always get in touch with me. So I'm hoping that I have saved you some fines. Now, let's get to some fun today. Now, here I want to talk about small business owners. You feel as though you don't have access to the same investment options as those employed at a large corporation. So I get asked a lot, what should I be doing to plan for my future? Well, it's an exciting day because I've got the best person on to answer that question. David Horvitz is a CFP, Certified Financial Planner. Professional, has been practicing comprehensive financial planning since 2002. He is skilled in the areas of taxation, mitigation, retirement planning, estate planning, insurance, and personal risk management. I am always so honored to have David on the show because he speaks real language to you guys directly, and you're going to learn in just a second why that is. David, thank you so much for taking my calls and coming back on the show all the time when I drag you here. It is so good to see your smiling face.
It's a pleasure. Lori, I'm always happy to be on your show and to join you. You have such great energy, and it's a great way to start the day.
Awesome. Now, I always tell David, and I did it before the show, I was like, David, I'm going to ask you to tell the story again because it's such an awesome story and it explains to you how David got into what he's doing and also so much about who he is as a person. David, please just tell us the story. How
All right.
did you
Well,
get into this whole thing?
thank you. It's one of my most favorite stories to tell, and it's that I was a teacher right out of college. I taught elementary school, fifth grade and sixth grade, and I loved it. And then in 2002, my grandfather, who was my hero, passed away. And my grandmother called me up and said, "You have to help me. Your grandfather took care of all of the financial stuff in the house, and I didn't do anything. And now I have lawyers calling me, and stockbrokers, and a CPA who says that he's taken care of our tax returns for the last 20 years, but I've never even met him, and I don't know the first thing of what to do. So I need your help." And I said, "Well, I'm a teacher. What makes you think I can help?" And she says, "Well, if you don't know this stuff, you better go learn it because we're off on a new adventure." And so that was 2002, and a couple of years later, I completed my coursework at UCLA Extension in personal financial planning, all the while every week going to visit my grandmother to say, "Hey, I learned what an IRA is. And hey, we need to call this person, and we never need to call that person. And this guy's helpful to us, and this guy's just a salesman, etc. And week by week, I was getting my grandmother's financial house in order for her, and which was a great relief to her and to me, actually, as measured by the length of time that we spent on the financial stuff got shorter and shorter and shorter, and the time that we spent talking about her cat got longer and longer and longer. And so I knew that when I would come over and she had the cat in her lap, that this was going to be an easy day. And unfortunately, at the same time, I was playing softball on a men's softball team on Friday nights, and I knew that the pitcher on the team was in investments. I really didn't know more than that, and I asked him if I could ask him about 1,000 questions about investing. And so we started having an extended conversation, and he said that if I should take and pass the CFP exam, and if I ever wanted to not be a teacher necessarily anymore, but still educate people, that his firm had grown to the size where he could use someone to help educate the clients about their financial situations. Not sell them anything, just educate them. And so after another year or so, I left teaching and joined the firm, of which now I'm a partner.
I
It's
love
20
that.
years.
I love that. And in so many ways, David, you never left teaching. It's just like with me. I remember back a long time ago, it was when I was going for my MBA, I took these, things they make you take, whatever survey about what you should be, et cetera. And it kept coming back, and it had repeatedly that I was a teacher, right? I'm like, no, I'm a big CFO. Don't be calling me no teacher. And now I realize, oh, no, I'm actually a teacher. I just am teaching CFO and, tax and all this stuff. But yeah, your spirit of teaching has never stopped. What I
True.
love about having you on the show and where I want to start it, and maybe it's just my experience, but you can tell me if you hear the same. When it comes to retirement, of course, everybody has it in the back of their head. Oh, I need to do retirement, right? So I'm going to talk about two different angles, and this is where we're going to launch. One of them is small businesses, and I'm talking about single owner LLCs, couple just shareholders in a corporation, especially sole props. They don't even think that they have the ability to set up a retirement fund through their company. They don't even discuss it as an option. They don't even know it's an option, right? That's the one angle. And then here's the other one, which is kind of fascinating on how they come together. Because so many people are influenced by social media. I get people constantly coming on my appointments. They haven't made any net income. And they go, I know I need a great tax strategy. I should be taxed as an S Corp. Okay, well, that has its benefits, but it's outrageously ridiculous for anybody that's just starting without the income to support that activity, right? And so I'm like, I got the best tax strategy you've ever heard of. It's great. And I say a retirement fund. And they're just mind boggled. So, David, not only are they not aware of the possibilities, but they're going to the most extreme, which actually costs them more money. I feel like we need some education going on here. We absolutely need some education. Now, what I loved, and I'm mostly giving you the stand in this, is that we looked at it from, and you do this all the time, if you have an employee, if you don't have an employee, which I think we got kind of a mixed group here, if you're a sole prop, how it doesn't differ, et cetera. So I'm really going to just let you take over with where you want to go. You're so great at it. And of course, I'll interrupt and ask questions that I think if I was in the audience, I'd ask. So where would you like to go with the format? Go ahead at it.
All right. Well, okay, great. Thank you. Yes. So I heard you say that many solopreneurs or self-employed individuals don't even realize that retirement plans are available to them. And they are. But before we launch into those, perhaps we should just back up just a second and go mention something else that you said, which is in many cases, opening a retirement plan might not be the best thing to do, particularly if they have no taxable income, because above all, retirement plans are a tax-saving tool. Then they have the added benefit of compounding returns over time without also not subject to tax until withdrawal. But um, before we even open a retirement plan, it's important that our businesses are profitable. If our businesses aren't profitable, quite often it doesn't really make sense to start a retirement plan. So let's assume that businesses are profitable. And now we're looking at tax strategies of how to reduce our taxable income as a business owner, one, but also to save money for the future in retirement, whenever that should happen in 5, 10, 20, 30, or 40 years, whatever it is. And there's a spectrum of retirement plans that are available to self-employed individuals. And the one that's most appropriate depends on a number of factors. One, how much income we're talking about. If it's a lot of income, like 300,000 or more, then we're really looking at kind of more advanced retirement plans that allow us to shelter more money from tax. And if we're only talking about marginally profitable businesses, well, then we don't need as complex a plan. And one might say, well, why don't I just get a more complex plan? Because if my income goes up, I'll be able to shelter more. And the answer is that the more complex the plan, the more expensive it is to administer. Many retirement plans, most of them, in fact, require their own individual tax filing. Many of them require the work of a professional actuary to determine just how much is allowed to be sheltered. And so if we're talking about a business that isn't at that level of income sheltering, then it's just a waste of money to create such a complex plan. So maybe we should talk first about which plans are least complex and which plans are most appropriate for the individual owner. Now, the IRS makes an exception when they say individual owner. It can be a married couple can count as an individual owner as well. And that's
Gotcha.
important.
Yeah. And I was just going to comment, I like where you're going because I see this in legal structures as well. I have people just start, and what I mean by this is they are doing today what they're planning that may happen. I may be this profitable. I may need to be a corporation because I may get investors, but they're just starting. So they get stuck between going all the way here for something that's unmanageable that they may not ever get to and not doing anything today for what makes sense. And so I see what you just spoke of, and I wanted to comment on that because I'm hearing the same thing in a retirement fund. Choose what makes sense today. And I love that. I just wanted to throw that in. So please, yes, let's look at where you're going. It's a great pathway to discover next.
Right. And, I should emphasize that almost all retirement plans are flexible in terms of you can change the plan with either very little cost or none at all. There's one exception that I can think of that where you're kind of locked in for 3 years, but it's not to say it's not reversible. It's not reversible for free. But otherwise, most plans can be changed year by year without cost, and more importantly, without tax. But so if we were to say, okay, I am a solopreneur or a married couple team with a moderate amount of income, say less than $10,000 after all of the expenses, and I'm just interested in sheltering up to about $10,000, then the most appropriate plan would actually be just a traditional IRA, individual retirement arrangement or individual retirement account. Anybody is allowed to have an individual IRA. It's a question that how much, whether it's a tax deductible IRA or a non-tax deductible IRA, is a question of how much money that you've actually made. But if we're talking about net income of, say, less than $100,000 for a married couple, then you can shelter each up to $7,500 in an IRA for each person in the marriage, or up to $8,000 sorry, $8,100 if they're over 50 years old. That's a direct, what's called above the line deduction. So it reduces your income dollar for dollar. The funds go into the IRA where they grow tax free until you take withdrawals at some point in the future. And you can take withdrawals as early as age 59 and a half without tax penalty. Um, and you can take them as late as age 73, or depending on your current age, 74, um, when you must begin taking what are called minimum withdrawals. Every withdrawal is taxable, but if it's before age 59 and a half, it also tends to be penalized by 10% because the government really wants to incentivize this as a retirement vehicle, not just a every year tax shelter. So the simplest one, like I said, is the IRA. It's free to set up. It doesn't require its own filing. It's very simple. And you have until the tax filing date plus extensions of the current year to shelter from the prior year. So you can still shelter 2025 income now in 2026 retroactively up until October 15th if you file an extension.
Can I ask a question
Yeah,
about that,
sure.
David? Does the account already have to have been open, or can it be opened up to October? Can it be a brand new account just opened?
Yes, great question.
Okay,
Also, yes, an IRA can be opened as late as, say, October 14th and funded
okay.
for the prior year. Other retirement accounts need to be opened by December
That's what I do.
31st of
Yeah.
the year for which they apply.
Well, this is
Um,
perfect. Guys, did you hear that? You still got time. I wasn't sure how that works. So thank you for that clarification, David. Keep going.
sure. Yeah. And then if we were going to go a little bit more complex, but we still wanted something that's free and doesn't require a separate filing or any other additional work. But again, for the solopreneur or for the solopreneur couple, um, a SEP IRA, which stands for Simplified Employee Pension, often called Self-Employed Pension, SEP, SEP-IRA. So it's also an IRA, but it allows you to shelter more money. You can shelter up to about $70,000 per person, provided that your income is big enough, because how much you can shelter is a function of a percentage of your net income. And a rough way to think about it is about 20% of net income. So my business does 300,000. I have expenses of 100,000. That's 200,000. 20% is about 40,000 is what I can shelter. So that reduces my income by that amount. And it goes again in the same kind of vehicle, the retirement plan, where the growth of it is tax deferred until I start taking distributions. And that's the SEP IRA. A slightly more complex one, but that still doesn't require filing or hiring actuaries or administrators, is, and apologies, the son loves to come in at this time, and
Oh, mine does the same thing. Please, none. I deal with it too. No worries. It's making you even brighter. So no
oh,
worries.
there we go. Okay, lovely. Um, the solo 401k, and again, it applies to couples. The solo 401k actually allows you to shelter more, because whereas the SEP, how much you can shelter in the SEP is a function of your net income, the income after all of the business expenses. The solo 401k allows you to shelter up to $23,500 per person on gross income, and then 20% of net income up to a total of about 70 to 73,000. The amounts change every year. So in other words, let's say that my net income was really only about $50,000. Well, that would really only allow me to shelter in a SEP IRA $10,000, 20% of 50,000. If I wanted to shelter the entire 50,000 or something close to it, a solo 401k would allow me to put in 23,500 right away. If I'm 50 or older, I could put in another 7,500. And then whatever is left from my net income, I can do 20% of that. So at levels below about $350,000 in income, uh, the solo 401k allows you to shelter more than the SEP IRA. The downside of the solo 401k is that when the account reaches an amount of 250,000 or more, you're required to file a special form. It's a pretty easy form. It's called a Form 5500, and it's actually a form that's filed with the Department of Labor. But regardless, it's an additional filing, which could create an additional cost or an additional hassle. So it starts to become a little bit more complex when you want to start to shelter more and more money.
I love this breakdown. Now, this is where I am just knowledgeable enough to be dangerous, because the only knowledge I have is myself having an individual 401k. Okay. And so one of the things, and you talked about the additional 20% of matching. Now, David, what I'm about to say is probably even incorrect. So you correct completely, because I only know my own world. I remember when somebody asked a question about, I think it was an IRA or a SEP, and I was surprised to see that there was what is called the company matching, which is what I equate the 20% in my individual 401k. So it made me wonder, totally innocent, but probably wrong, stupid question. Does it matter whether this account is set up under the company or not? Like, I remember having my own individual SEP, not through my company, and now I have this individual 401k and I get this extra 20,000. Does a SEP or an IRA get in a company's name versus not? Because my individual 401 is in my company's name for sure. Do you see where I'm going? I'm going in a ton of circles, and I get asked that, well, do I set up my company? And I'm like, I don't know. I only know my world. So can you correct everything I said that I said incorrect and shed some light on this? Because I've been asked this confusing question as well.
Sure. So it sounds like you're talking about two things. One is, what's the registration of the retirement account, as in company or individual? And the second thing that you mentioned is about this idea of the company match.
Yeah.
And they're two different things.
Okay.
So let me talk about the first, which is the registration. So unless you're talking about an IRA, which is available to any individual, whether they're a company owner, an employee, a W-2 employee, or they're 1099, or they distribute 1099s and W-2s as an employer. Doesn't matter. An individual IRA is in the name of the person. That's
Okay.
the only one that's in the name of the person. All the other retirement accounts are in the name of the company. If they're, say, a SEP IRA, or really most all of them will say Lori Williams Inc. SEP IRA FBO for the benefit of Lori Williams. So it's the name of the company retirement plan for the benefit of the individual. So that's the case with SEP IRAs and individual 401ks or solo 401ks and regular 401ks and other retirement plans too. The second part that you were mentioning is about the match. The match, which is really what most employees are familiar with, because it tends to be a benefit to an employee that works for a company that has a 401k with a matching feature. Not all 401ks have a matching feature, but many employers will offer the matching feature as a bonus to encourage an employee to stay with the company. And the match is usually a percentage of salary, including bonus, up to a certain amount, 5%, 6%, up to the statutory maximum, which is about $35,000. Though most most employees don't receive that. Um, so the match is a separate feature of a 401k plan, and it's always up to the employer to offer the match or not. But when it is offered, it's usually a percentage of the salary. Now, with a solopreneur or a couple who have the 401k, they can elect to create a match for the employee, which is themselves.
Right.
So
That's what I'm.
there's always two components to a 401k contribution: the employee's contribution and the employer's contribution. So the employee has the ability, if there is an existing 401k, to shelter up to, let's just call it about $20,000 of their income, of their wages for themselves. So that's regardless of what the company does. The company may have a match and says, if you put in whatever you put in, $10,000 or more, we'll put in 5% of your salary. So you get the employee contribution and the employer contribution. So, but if the company is owned by an individual, that individual is both the employee and the employer. So that individual says, okay, I'm sheltering for myself as an employee, and I am giving a bonus or a match to the employee who happens to be me, up to whatever the maximum is or what I can afford.
Got
And
it. That makes sense. So then my ability to do that, like I said, I know my own world real well, is not because I'm taxed as an S corp. That's available to those that are not taxed as an S corp. It's the company owner concept of being an owner and an employee. It's not the S corp status that allows me to do that. See, that's what I didn't know. Once again, outside my own world, I just, because I'm not selling this stuff, I'm not answering questions on it. Somebody asked me, and I said to myself, is it because I'm taxed as an S corp that I get to do this? Because you're an employee. So, it's really interesting because it goes to show all of the different options. And before you jump into the next, I just want to make this statement, and I think it's so fascinating, and I always get it wrong. I think it was Ben Franklin. You always correct me on that. But even if you have just a little bit of pennies to put into this, it's so worth it. That's all I'm making a statement here. It's like, people hear, well, 10,000, I don't have 5,000. I remember it was many years ago working with my tax person. He said, I had to pay in an extra, like maybe 3,000 or 4,000. He goes, well, if you put another 1,000 in, I don't remember the number, but you'll save maybe 100 or two from the taxes. I was like, these numbers aren't right, guys. But I thought to myself, oh, wait a minute. I either pay the IRS this, or I pay them just a little bit more and I put this over here. And I only put an extra deposit of about 200 or 300, but 200 or 300, why give it to the IRS? And that was my first concept and introduction to, oh my God, look at, if you're paying a penny in, take some of those pennies and give it to yourself.
yes, that's it. That's exactly right. And I think that the perhaps the quote you're thinking about is, I mean, Benjamin Franklin said, a penny saved is a penny earned. But there's then Einstein, supposedly it's attributed to Einstein, says that the eighth wonder of the world is compounding, which is, it's not just a penny saved is a penny earned. A penny saved becomes many, many pennies earned over time, because the growth of the penny on itself goes higher and higher and higher, and eventually it'll double or.
You're right, and I never think Einstein. Because I can't figure that relativity and Einstein and compounded interest, but I guess they have a relativity in our financial world. So I never think it's Einstein. You always correct me, and I think it's a cool thing, and I forget it by the end of the day. Yes, Einstein.
Well, we'll have to talk again so I can remind you.
I
know. But the what you said is exactly right. The idea is that here's my income, and the IRS will say to me, okay, you made this much income, we want our share, 20%, 30%, whatever it is. If your income is less than 20 or 30%, is going to be less. And the whole purpose of the retirement vehicle is, in the eyes of the IRS, to make your income less. And you're just taking it from today's earnings, and you're putting it in a special account called qualified account. Qualified is IRS speak for tax benefit. And to a qualified account that belongs to you, it's in your name, where it can grow over time. And in this year's tax year, you've made less money. It's not that you actually have, it's just that you've put it over here where it grows over time and it's not subject to tax until you start taking it out.
Yeah. And I remember just always thinking I had to put some away because I was in an error because I started my first company at 25. It said going to be 62 next month. And I was always told how stupid that was. And I didn't have the 401, because that's all we talked about back in those days. You need to get with a big employer and have a. So because of that, I was like, oh, I did a stupid thing. I better put a penny away. And now I could technically retire if I wanted to. And it wasn't that I've made a ton of money over my life. I just kept putting a little penny away. So Einstein was right on many things, and even this.
Yeah, well, if you allow me to go off on a bit of a tangent,
Please.
when I was teaching personal financial planning, both to young people, middle schoolers and ninth graders, all the way through adults at UCLA Extension, I gave the example of twins, Sam and Sandy, who are 20 years old. And Sandy decides that she's going to save $5,000 a year in an IRA. And she does it from age 20 to age 30, 11 years total. And Sam says, I'm going to start at age 30. And I'm not going to save just for 11 years. I'm going to save from age 30 to age 65. So he saves for 35 years. He saves for more than 3 times as long as Sandy does. And he puts away 3 times as much. So even though Sandy only puts away for 10, 11 years and Sam does it for 35 years, at the end of when they're both 65 years old, assuming that their rates of return are the same, Sandy has twice as much money as Sam, simply because she started that much earlier. The power of compounding is so strong that you don't even have to have saved a lot of money, and you certainly don't have to have amazing returns. If you've done it for time, that's going to be the most powerful ingredient, so much so that you can have twice as much money by saving for 1/3 as long as somebody else, provided you started sooner.
Absolutely. I mean, I remember, especially in my challenging, we were talking about that before the show, my challenging 20s and 30s, even to the point my 40s in business. David, I really literally thought I was going to end up broke and in a lot of financial trouble. I really did. Because back at that time period, it was so much of a struggle. And so it is an amazing thing. Now, let you continue if we missed any products, but I wanted to throw this in here and correct me because like I said, can be dangerous. I think that what we're speaking of now works ideally when you have no employees other than yourself. I think that's another thing we have to know, which is the majority of our companies now. They're more the employee-less companies. And so we are speaking a lot to the audience, but that's the big distinction with what we said so far. Am I correct?
Yeah, that is correct. And there's one other that's super valuable for an employee-less company, no employees, and that's the defined benefit pension plan. It can allow you to shelter about $250,000 per year, depending on certainly income, but also your age. However, because it's a big shelter, it requires a lot of folks. You need to have what's called a third-party administrator, who's often also an actuary. It needs its own separate tax filing, and the records need to be meticulous, and you have to keep it in force for about 3 years, which means that if you don't think that your business can afford to put away about $200,000 a year for at least 3 years, it's probably not the best plan. But just know that it does exist, and we're talking about, obviously, on the lowest end, sheltering $7,000 in an IRA every year, to on the highest end, $250,000. So the spectrum is quite wide. But again, this is for solopreneurs or couples, and as you said earlier, you don't have to be an S corp, you don't have to be a C corp, you don't have to be a partnership or an LLC. You can be any of those things, and these plans are available to all of those registrations. But you do have to have income, and you do have to have it be business income. So it's not available to you if you receive a W-2 unless you receive it from your S corp as your own employee. But otherwise, it's for any registration.
You
And
know,
then
something I
yeah,
learned from you last time on the individual 401, and of course I don't remember it just like Einstein, just enough to remember it a bit. Didn't you tell me that on the individual 401 you can get maxed out on the amount you can put into it, but then there's an option to take some of it out or something? Okay, I'm totally wrong on how I'm trying to say it, but you get, like after a while the individual 401 can't have that much money in it. There's some kind of something.
yes. So, right. And I was briefly mentioning that, which is just that it's not that it can't have more than a certain amount. It's just that it starts to require a certain filing,
Form.
and that
Okay.
amounts 250,000. So
Right.
up to 250,000 in your individual 401k, no special filing, no additional costs.
Right.
251,000 or $250,001 and over, you then have to file what's called a Form 5500. And it can be as simple as a one-page form, but alerts the Department of Labor that this plan exists, so that in case you're doing anything nefarious or illegal, they're aware that the plan is there and they can investigate. That's at 250,000 or more.
Gotcha. Okay, so now I'm going to ask a somewhat controversial question, which you may have it in your wheelbar or wheelhouse, however you say that, or may not. I get asked this question more than I like to even answer it. People are starting a company. They want to borrow against one of these 401s. I am not in favor of it unless it's a slam dunk friggin' given, which isn't usually the case, right? So I feel like if you're needing to borrow against a 401, maybe figure out different ways to start it smaller, start it organic. I just not in a big comfort zone. And I also am not knowledgeable of this, but I think when you do, you've got some strict requirements of some kind of payback into that or something. Once again, I'm talking about it. I don't know enough, David, but I think we should mention that if that's something you can mention, because I get asked that a ton.
Yeah. Well, so I am in total agreement with you that you've got to be very, very careful if you do one of these. And it's the acronym is ROBS, which is, I think,
Yeah.
Rollover Business Startup, which is it's an exception for borrowing from your 401k. There's certain exceptions that allow one to borrow from their 401k, a down payment on a house, education expenses, medical expenses. These are all free from penalties and can often be structured as loans from the 401k that you, the employee, pay back essentially to yourself. There's a bit of a tax disadvantage to these loans, so they're generally not a good idea. But if the money is needed for obviously for those kinds of reasons, it might make sense.
Great.
If we're talking about I need $50,000 from my 401k to launch my business, well, there are very strict requirements and record keeping that must be done, and certain expenditures that are allowable and certain expenditures that are not allowable, to make sure that you're not violating the terms of this ROBS loan. Because if you violate them, the result can be not just taxes, but also penalties. Plus, there are a ton of firms on the internet that promise to make sure that you're staying compatible, and they can cost $5,000 or more to administer a year. And so you have to ask yourself, is it worth me really doing this? And so it's like you said, Lori, it better be a slam dunk business. Otherwise, I recommend finding other sources of income, small business loan. There are a number of charities that make small business interest-free loans. I sit on the board of one of them. It's called JFLA.
I knew you were talking about that. Yeah. Yeah.
Okay, so I recommend not borrowing from your 401k in most any circumstances except for an emergency, but almost certainly not to start a business.
Yeah, and you know what? Whenever I get asked questions, it's amazing because they always come up, and then suddenly, because everybody goes through me through SBDC, I get more than one and more than one, and then I look up and I go, "Oh yeah, social media has been promoting something." So those companies that charge those fees have had all these promotions on social media. You can start your company. That's where all these calls come from, and I'm glad you discussed that and mentioned it because I didn't know the full story. I was just like, "No, I don't know about it, but I don't think you should do it." That was the end of the advice I gave on
The
that.
advice is the same, whether it's as simple as simply put as you put it,
Yeah.
or more complex. You are absolutely right. Just let's not do that. Pass on that
Yeah.
one.
Yeah. So I think we might have covered all those without employees. You correct me if I'm wrong, but I thought if we have, we'll just briefly, because I don't have a lot of audience with a lot of employees, but let's at least briefly, okay, had to, and you're probably familiar with what I'm talking about. AB5 is forcing a lot of people to hire. And even if they're a yoga instructor and they want somebody to come in for a couple hours, they, by ruling of AB5, have to now put them on as a part-time employee. And I don't know how that messes up all your no employee type of retirement funds that you have. And I am concerned about AB5. I've kind of not been for it since it first was a bill because it's such a huge impact. So may we talk a little bit about everything I just said, because I know I unpacked a whole lot once again. I'll just throw it to you now, David. You clean it all up, okay?
So in short, yes, these kinds of legislation tend to make it more difficult for the individual business owner to run their business without additional costs, expenses, legal requirements, etc. Um, Fortunately, many of the retirement plans that I mentioned before have exceptions for part-time employees. In other words, with the solo 401k, for example, unless the employee is working more than, I think it's 500 hours a year, they don't have to be included in the plan. Or if they're under 21, they don't have to be included in the plan. In some cases, you can create a tenure that they have to have accumulated before they can be eligible to participate in the plan. 1 year, 2 years, 3 years before they're eligible. So there are some routes that a clever employer can take to still be classified as a solo plan. But let's say that that's not the case. Then the most flexible plan is still the traditional 401k, because the traditional 401k does not have to offer the matching feature, which means that the employees are only sheltering their own earnings. So there's no additional cost to the employer for the employee to shelter their own earnings. It's whatever they want, and the employer is paying them anyway. And because the employer can also be a participant in the plan, they can shelter their own earnings as well. The disadvantage is the so-called match, or that additional bonus that the self-employed person can pay to themselves as the employer bonusing the employee, which is themselves to themselves. In the traditional 401k, that option is still available, but you can't just say, all right, I'm just going to bonus myself as the
Yeah.
employee owner. You got to bonus all of the employees in a reasonable way, and there's a formula for it. But you can still shelter, call it $23,000 a year, and in some cases $30,000 if you're over a certain age, and even more if you're between age 60 and 63 for a short period of time. It's a weird new catch-up provision. But the point is that you still have the option to shelter quite a bit. The only other downside of that 401k for employees, even if the employer doesn't provide the match to the employees, is that if it's not a solo 401k, it automatically requires the filing of the 5500 form.
Okay.
So you certainly have to do that one, even if it doesn't have a balance of 250,000 or more. But you have to do the 5,500, which is an additional hassle or maybe a cost. And you almost certainly also have to have a third party administrator, which might be $1,000 or $2,000 a year or more. But you have to just decide as the employer, is it worth it for me to pay $1,000 or $2,000 to shelter $30,000 for myself and to give the opportunity for my employees to shelter money from their income?
Yeah, I have to say that once again, enough to be dangerous, my experience with that was being with a company, my private business, that had a very large investment into them, like $6 million, right? But the company was just making a little bit of money, but they wanted to have a retirement fund for their employees. And being in the CFO position, I had to, participate in the meetings with the plan. I think it was like through one of the big banks setting it up. And David, I was amazed about the regulatory and the documents because you had to make sure that the employees are fair in this and what stock you put in. It was, I was just sitting by and attending the meetings. I wasn't paying for anything, but I was still very much educated in that process. So, me being the CFO type person, right? When a company does have employees, and I fully get the do good, I want to do good. I got a few employees. I want, and do correct me if I'm wrong because I come at it from a money position, right? I am always kind of like the amount of employees you have, the cost you would have to create this program, the amount of lack of flexibility you have. Just stay with your own personal, let them get a personal, pay them well, let them put the money, and don't put this plan in place. Okay, I that's just my personal opinion, and it's just kind of how I think about it. I could be wrong on the advice I'm giving. You tell me, David.
I don't think it's wrong, especially at, below certain thresholds of income. It goes back to what we were talking about before. You're creating a plan that may be too complex, as in too expensive
Yeah.
unnecessarily. And fortunately, there's an option that's also like with in terms of flexibility, like the 401k, that's a free option, which is called the Simple IRA, SIMPLE, and it's an acronym. And right now, I don't recall what it stands for, but it's basically the same thing as the individual IRA, which is available to anybody, W2, K1, whatever you are, 1099. And it just allows you to shelter just a little bit more. I think that the limitations on the simple IRA for employees and a business is somewhere around $12,000-$13,000 a year. So you can shelter a little bit more than the traditional IRA, and it's free to set up, and it doesn't require an administrator, but you can't shelter as much as the 401k. So it's somewhere between the do nothing and let everybody open their own IRA and go to the 401k. What I would caution any employer with employees is don't use a SEP IRA, because even though that SEP IRA is very good for the solopreneur or the couplepreneur because they're sheltering their own money for themselves, it's usually not good when you have employees, because it's the percentage of net income that you are sheltering for yourself is the same percentage of the employees' wages that you would have to shelter for them.
Yeah.
So if you're sheltering 20%, that can be quite a bit for an employee that you just wanted to give the opportunity to shelter some of their own money. No employee money is going into a SEP IRA that's established by the employer. It's all employer money and can end up being really expensive.
Really costly. I remember hearing somebody mention that, every year we were talking about it for my enrolled agent, I have to go through my special credits and you get to choose what subject to study every year for your credits. And okay, I'm going to use the word, David. I forced myself to do the classes on the retirement funds because I just gloss over it. There's so many, and it's like I still don't get it. Every year I go, okay, I got to do my extra credits. Okay, yes, Lori, you must get the one on the retirement funds. I'm like, let me just do a Schedule C. I can get past the test real quick, But it gets glossed over. But the thing that I get so reminded of when you come on is that there is the right plan for every situation, but you really want to understand and have someone like yourself. You're such a great resource. And please, David's contact information has gone into the chat. Reach out. David will have a conversation with you to see where you're at. Please do. But having someone to choose with you that knows what they're talking about rather than researching it on the internet, just like I believe with finance, tax, and legal structures, is just vital. You really need somebody to go through and tell you what is important where you're at today. So I'm not a big fan of if you're not making money and you can't even put away a penny, we got a problem here. And I talk about that all the time. I always say, and my audience knows it very well, say, okay, your business idea may sound really cool, but can you buy a freaking quart of milk? If you can't buy a freaking quart of milk, it's not cool. That's the bottom line. People will say, well, I want to be a real business. Well, then be able to buy a quart of milk. That's my criteria for a real business. Not the little LLC Gucci bag that you're holding on to. You got to be able to buy a quart of milk. But when you get to that point, choosing something versus nothing is such a smart business move for yourself and for your future. It really is. So as we're getting near the final minutes, I have to come back to something about the story. I want you guys, the audience, to know how Grandma's doing today. And I want the audience to also know how well David did at planning for Grandma's financials, given when Grandma could be still alive. Okay. So let's talk about David's financial planning skills for his grandma. I think 2002 was when you first started, addressing this. So give us an update on Grandma.
So Grandma, who I call Nana, is 100 years old, and she's very, very happy and generally pretty healthy. Mind is going a little bit, but she just lights up when I come in, which is all that matters to me. And I told her about 20 years ago that I estimated that she would have enough money to age 104. And now at age 100, she reminds me, you said that I'll have enough money till 104. And I'm only tongue in cheek, slightly concerned that she might outlive her money. I mean, I hope she does, and we'll just figure it out at that point. But yeah, we're getting there. So yeah, it's all around really a lucky, happy, blessed thing. I'm a very, very, very grateful guy to have her in my life.
I feel like the taping of this show could be seen on network TV because it's been educational, entertaining, and inspiring, all about retirement funds, which you usually don't have a show about retirement funds that we would call, yes, educational, entertaining, fun. No, you usually don't. David, I just want to thank you so much because you break it down as Business Simply Put. My company name always was Simply Put. You break it down so clear. And I think it's a gold mine of information, pun intended, gold mine, for people to know about and understand. And so any last statements you'd like to make? And I want to say once again to the audience, I know Sadie's been putting David's information in. Please reach out to him if you've got any questions. He's just golden in his information, as you can tell. Last final words you'd like to give, David?
Yeah, I would just like to say that if you take anything from this conversation, let it be this: get out of debt, particularly credit card debt. And once you're in a healthy savings environment, then you should investigate the retirement plans that would work best for you. But number one is don't be saddled by bad debt. There's no benefit to it whatsoever.
Yeah, I fully agree. I've always well, first of all, my parents were not through the Depression, but they were kids during that time period, and you would think they actually went through the depression themselves. They just really were hardwired for that. So I was hardwired for a depression mentality, right? So, buy everything on cash, buy everything on cash. And even though I've had my times through my life, who doesn't, that you borrowed money, I kind of have remained mostly not, and definitely not for the last several decades. And I always felt like if you had where you owed anything, you gave up a piece of yourself. Somebody owned you. And I guess it's always been my nobody's going to own me. But what I love about not having debt is you have freedom of choice. Nobody can force you to stay at a company, force you to do this. You have freedom of choice. So I think that the advice of not being in debt is good mentally and spiritually and physically just as much as it is financially.
I
Yeah.
agree.
Yeah. Well, Sadie, we're right at that time. Has this not been entertaining and educational?
You know what? It's my favorite jam. I'm not gonna kid. It's like it's one of those things of like, as you said, just make it seem like normal conversation. Ah, I get it. Thank you, David. Thank you for just making it
Yeah.
seem normal.
It's my
I think
pleasure.
that's a perfect way to put it. Okay, so as always, guys, Sadie's going to stay behind a little bit longer. That way, you have full access to the chat. You've got David's information, my information, SBD's information. Everything you need will stay in the chat. Sadie will stay behind. David, I'm going to bother you again and come back and get you to come back on the show. And one of the things that I always learned that was really cool is many individuals on their situation still have time to open and fund an account. They still got time to do that. So it is not too late. You got till even extensions, guys. Get started on just putting a penny away. Einstein knew what he was talking about. Okay, he definitely did. So for me, it's time for me to say goodbye. So those of you who are there every single week, I see your names every week. Thank you so much for joining me. If you were new, please stay with the program. There's always something interesting to learn and hear about. And thank you again for watching Small Biz Talk with your host, Lori Williams. And I'm going to see everybody next week. Bye, David and Sadie, and everybody. See you next week. Bye bye.
Bye, guys. Bye, Lori. Bye, David. Alrighty, guys. We know the drill. We know the drill. And if it's your first time, hey, I'm going to give you a quick little breakdown. Check out this chat. I reposted everything in there for links, Lori's classes, information, David. If you want to watch past shows, you want to get in contact with Lori. Bye, Lily. So yeah, definitely take a little moment, scroll through, just click away on the hyperlinks. I know Zoom does the updates, so maybe you'll have to click once on the hyperlink or maybe it's twice. But don't worry, don't stress. I'm going to be here for a few. So just launch away, maybe, just click on all those URLs for Lori's webinars. Like I said, don't worry. I'm just going to put myself on mute. We'll be here, but just get on those links because once I close the Zoom, the links go away. So we definitely want to make sure that you guys get the information that you want and need because we definitely want to take care of our small business owners. All righty, guys, I'm going to put myself on mute. I be here.